Cheers, guys. Let's go through the step number 4 now, allocation of transaction price. So, what we learned in step 3 is what is the contract price at initial recognition. It will be a fixed price plus variable price plus non cash consideration minus any consideration to be payable back. Now, last three items, that is a non cash consideration payable back to the customer, financing component, non-cash consideration, all these are variable items which we need to estimate and determine a one transaction price such that a significant revenue reversal does not happen in the future. Now here there is a one key aspect, revenue recognized on each performance obligation, that is as and when the performance obligations identified in step 2 gets satisfied, we will recognize the revenue. So here is a one very important thing, that we have a contract price overall and we have multiple performance obligations. Now we need to split our contract value in such a way that it reflects the fair value of services to be transferred for each performance obligations. Let's take an example. I'm a chartered accountant. I'm providing them accounting service, tax return filing service, project finance service, and audit advisory. I'm providing him a four service for a $1 lakh consideration. Now, I need to allocate the services for all the four items: accounting, auditing, tax filings, advisory. All the services I need to allocate $1 lakh to all of these services. Now, standard gives a few approaches. It standard says you need to allocate the price at a stand which reflects a standalone selling price of your consideration. So for example, if I am giving $10,000 for accounting, $10,000 for auditing, $10,000 for project finance, and rest $70,000 for other services, then if it is my standalone selling price, I can allocate $10,000 for first three service and $70,000 for rest of the services. However, if standalone selling price is not readily available, then standard has given certain other options. Option number 1, adjusted market approach. It says that in the market where you are doing your work or practice, what price other chartered accountants are charging for the similar work. Let's say we identify other chartered accountants are charging $25,000 for all each of the services, then basis the market price approach we can allocate $25,000 to each of the services. But let's say this is very easy in a way that you are doing a one established practice, that is a good enough market for you and your customer, you can use the market price approach. However, in the industry, you are a customer specific or a custom industry, like you are building a IT solutions, you are doing a research services, where you don't know average rate of being charged in the market for the same services, and it depends, it is a customized. In that situation, your market price approach will not work. In that situation, standard says, okay, let's go with the cost plus margin approach. First, you identify what is the cost of delivering that services, add your appropriate margin, and then allocate the price in the ratio of cost plus margin. So for example, I identify that to provide all the services I need $20,000 for accounting, 20,000 for audit, 20,000 for project financing, and let's say 40,000 for something else. So I need to allocate my contract value in the ratio of 20 is to 20 is to 20 is to 40, and I need to allocate my transaction price of $1 lakh to each performance obligation. Now companies cannot argue that they cannot use cost plus margin approach, because whenever you are signing a one particular deal, you know what is the cost of delivery, you know what is the cost you are going to incur, you know what is your margin. So cost plus margin is an approach which has make sure that all the industry are covered under the fair value approach of cost plus margin. The last one says the residual approach. Now, residual approach comes into a picture where you are selling something for a very first time. There is no market available, neither you are sure about the costing aspect of that, and you are not sure how you allocate the value. So standard says do one thing: take total contract value, deduct identifiable fair value of each component. The balancing figure will be allocated to a new element as a residual price. For example, as a CA, I am providing US advisory services for the very first time. No one in the market provides that. I don't know what will be the cost of delivery. What I will do, out of total 1 lakh, I will deduct accounting, I will deduct audit, I will deduct project financing. The balancing figure I will allocate to the residual approach. There is one practical issue with the residual approach. It will not work in a case where your standalone selling price of each component is higher than your signed contract value. That means you are involving any significant discounting component. What happens that you are signing a $1 lakh deal for accounting auditing services, but your accounting service fair value is $60,000 and auditing is also $60,000. So your fair value is 1,20,000. However, you are providing these services at $1 lakh. That means there is a discount component of 20,000 involved in the contract. Now you need to allocate this discount in the ratio of standalone selling price to each accounting and auditing, unless you have a clear justification that discount pertains to only accounting or only auditing. If you can justify, then standard allows you to deduct the discount only from either accounting or auditing services. Now, wide residual approach becomes a challenge that if your accounting and auditing is $1,20,000 and there is a third unknown element, then you don't know how much residual value you can allocate, because your fair value or standalone selling price itself is higher than the signed contract value. So this generally becomes a challenge to use the residual approach. So determining the transaction price in step 3, that price will get allocated in step 4 to each performance obligations identified in step 2 at standalone selling price. How to find standalone selling price? 3 option: market option, cost plus margin, and residual approach. If there is any discount, that means your standalone selling price is higher than signed contract value, then there is a discount component involved. You need to allocate discount either in the ratio of standalone selling price, unless you have a clear justification that discount is related to a one or some other performance obligation and you do not want to use the standalone selling price ratio. There can be a subsequent changes to a transaction price which are covered as a part of contract modification in step 1. There can be a combination of the contract. Again, these are covered as the part of step 1. So this is very important aspect, that we need to allocate the transaction price to each of the performance obligation, and subsequently revenue will get recognized for each performance obligation. How it will get recognized, we will see in our next session, that is session number 5. Recognize the revenue as and when performance obligations get satisfied. Till that time, cheers, thank you so much.